The room is dim, the tablecloth is linen, and the plate arrives too hot to touch, 500 degrees Fahrenheit, sizzling audibly as it's set down, exactly as it has been since 1965. A ribeye costs $60. Somewhere else in the same country, at the same hour, a legendary steak costs $19. And somewhere else again, a chain that didn't exist in the United States 40 years ago is charging $70 a head for all the meat a table can carve, and growing 15% a year while doing it. Restaurants as a category are one of the worst businesses in America to be in. The average full-service restaurant keeps 3 to 5 cents of every dollar it takes in. Roughly 1 in 6 closes within its first year. And yet the steakhouse, arguably the most expensive, most labor-heavy format a restaurant can run, keeps producing some of the industry's most durable, most profitable chains. That's not a coincidence, and it's not a single formula. It's 4 different bets on the same constraint. Ruth's Chris bet on scarcity and grew on purpose at a crawl. Texas Roadhouse bet on volume and built almost 700 stores doing it. Outback Steakhouse bet on being everywhere and has spent the last 2 years closing what it built. And Fogo de Chão, a Brazilian import, is proving there's still room for someone new. This is the autopsy of that bet. 4 companies, 1 product, 4 opposite strategies, and the one cost none of them has figured out how to escape. American steakhouses trace back to the fine dining rooms of 19th century New York, and the format spread nationally after World War II, when rising incomes, interstate highways, and reliable cold chain beef supply turned a thick cut of steak into a symbol of prosperity available well outside the coasts. By the second half of the 20th century, steakhouse had become one of the few restaurant categories in America where customers expected and accepted a genuinely high check average in exchange for a specific, repeatable ritual, a quality cut of beef, cooked to a stated temperature, served with some ceremony. That ritual sits on top of one of the least forgiving cost structures in retail. Full-service restaurants in the United States average a net profit margin of just 3 to 5%, well below the roughly 8.5% average across all industries. 2 line items explain almost all of it. Food costs typically run 28 to 35% of revenue, and labor runs another 25 to 35%, climbing toward the higher end, 30 to 35%, at fine dining restaurants with larger, more skilled front and back-of-house teams. Add those 2 together and you get what the industry calls prime cost. The benchmark for a healthy restaurant is to keep prime cost at or below 60% of revenue. Cross much past 65%, and the operation is very likely losing money. Those numbers are exactly as unforgiving as they sound. Roughly 14 to 17% of new restaurants close within their first year, a real number, though far below the mythical 90% fail statistic that gets repeated without a source. About half survive past 5 years, and only around 1 in 5 makes it to 15. Restaurants with less than $2 million in annual sales report a median pre-tax income of just 1.1%. Larger, higher volume locations do better at 4.3%, because scale is one of the only things that reliably absorbs a restaurant's fixed costs. Steakhouses live inside that same 60% prime cost ceiling as every other full-service restaurant. Beef is not cheap, and carving or grilling it correctly requires skilled labor, not less of it. Labor alone routinely runs 30 to 35% of revenue at a fine dining steakhouse near the top of the entire restaurant industry, because the job requires servers who can describe a dry-aged ribeye, sommeliers who can navigate a wine list, and cooks trained to hit an exact temperature on an expensive cut that can't be remade if it's wrong. What makes the category interesting is that, unlike most casual dining segments currently losing ground to value-driven competitors, a meaningful number of steakhouse chains have found ways to consistently beat the category's own average. They just haven't found the same way to do it. It also helps that a steak, unlike a lot of other full-service menu categories, is relatively simple to standardize across dozens or hundreds of locations without losing its appeal. An Italian-American casual chain has to get a whole menu of sauces, pastas, and proteins consistently right across every kitchen. A steakhouse largely has to get one thing right: the cut, the temperature, and the sear, which is exactly why the category has produced so many durable regional and national chains despite its labor intensity. That simplicity of the core product is part of why 4 such different strategies can all coexist profitably inside the same category, rather than one obviously correct playbook driving out the other 3. 4 companies make that point clearly because each one answers the exact same constraint: expensive product, expensive labor, a 60% prime cost ceiling, with a completely different strategy. Ruth's Chris Steakhouse, tracing back to a single New Orleans restaurant bought by Ruth Fertel in 1965, chose to stay small and expensive. Texas Roadhouse, founded in 1993 in a converted car dealership in Clarksville, Indiana, chose the opposite: get big and get big on volume. Outback Steakhouse, invented in Tampa, Florida in 1988 around a fabricated Australian theme, chose to expand as widely as possible on multiple continents and is now retreating from parts of that footprint. And Fogo de Chão, a Brazilian churrasco concept founded in 1979 that didn't reach the United States until 1997, is the newest and fastest growing entrant, proving there's still room in the category for a 4th approach. What follows is the unit economics behind each of those 4 bets, and, at the end, the one number that explains why not a single one of them has escaped the constraint. Every restaurant on earth is fighting. Ruth's Chris Steakhouse did not start as a growth story. It started as a rescue. The restaurant traces back to a single location on Broad Street in New Orleans, opened in 1927 under the name Chris Steakhouse. In 1965, a divorced mother named Ruth Fertel, working as a lab technician and looking for a way to put her 2 children through college, mortgaged her own house to buy it. Even the chain's tongue-twisting name is an accident of that scrappy start. After a kitchen fire destroyed the restaurant in 1976, the sales contract with the original owner barred Fertel from using the Chris Steakhouse name at any new address. With days to reopen at a new location down the block, she simply added her own name to the sign, Ruth's Chris Steakhouse, and kept the brand her regulars already trusted, rather than start over from zero. She would later admit to a reporter that she'd always hated the name, but it stuck for exactly the reason. A business built on reputation needs it to: continuity. For decades afterward, the business grew the way a lot of independent restaurants grow, slowly, one location at a time, built on service and reputation rather than outside capital. The first franchisee opened in Baton Rouge in the late 1970s, and franchising, not company-owned expansion, did much of the work of taking the brand national over the following decades. That pace never really changed, even once Ruth's Chris became a public company with dozens of franchise partners. In 2021, coming out of the pandemic, the chain finished the year with 150 locations total, 74 company-owned, 72 franchised, and 3 managed. Heading into 2022, management projected opening 5 new restaurants. If Ruth's Chris hit the top of its own stated target that year, 7 openings, that would still be its fastest pace since 2008, when it opened 12. For a company with over 150 locations, fast growth meant single digits. That slowness is not incompetence, it is the business model. A steakhouse charging premium prices for USDA prime beef served on a nearly 500-degree sizzling plate by a trained server who can describe every cut on the menu cannot be built the way a burger chain is built. It needs an experienced kitchen team, a wine program, and real estate in a market that can support a $60 entree. And, critically, a level of scarcity that keeps the brand feeling special. Grow too fast, and the thing that makes people pay $60 for a ribeye stops feeling true. You can see that fragility in the chain's own numbers. In the fourth quarter of 2021, Ruth's Chris reported total revenue of $126.7 million, more than 60% above the pandemic-depressed quarter a year earlier. But same-store sales, the metric that strips out new openings and measures whether existing restaurants are actually doing more business, grew just 0.5%. Management said roughly 6.5 percentage points of that softness came from just 3 underperforming markets: Boston, Manhattan, and Hawaii. When a chain's footprint is small, 3 struggling cities can move the whole company's growth rate. That's the trade-off for scarcity: less exposure to bad locations, but also nowhere to hide if a handful of them go wrong. To keep growing revenue without adding many restaurants, Ruth's Chris leaned on the one lever every fine dining chain has: price. The company carried a 6.4% price increase into 2022, on top of an incremental 3% bump added that March, guests paying roughly 9% more for the same dining room and the same sizzling plate. Management's language made the strategy explicit. They expected guests to accept it because of the value they are getting when dining in our restaurants. Brand equity doing the work, not additional capacity. By 2022, that formula produced real numbers: worldwide revenue of roughly $505.9 million and net income of about $38.6 million, a net margin near 7.6%, well above the 3 to 5% typical for a full-service restaurant. Slow, expensive, and hard to replicate, but genuinely profitable. It's also worth noting how much of that footprint isn't even Ruth's Chris's own capital at risk. Of the 150 locations standing at the end of 2021, 72 were franchised rather than company-owned, meaning nearly half the brand's growth over the decades came from local operators putting up their own money for the right to use the name and the recipe, a quieter, lower capital version of the same scarcity strategy. Then, in May 2023, the strategy changed hands. Darden Restaurants, the company behind Olive Garden, Longhorn Steakhouse, and the Capitol Grill, agreed to buy Ruth's Hospitality Group for $21.50 a share, a 34% premium in an all-cash deal worth about $715 million. The acquisition closed the following month, bringing Ruth's Chris's 155 locations and roughly 5,000 employees under Darden's roof as its 4th largest brand by unit count. Darden did not buy Ruth's Chris to keep it slow. Executives publicly described it as a growth brand, one they believed could expand near the high end of Darden's own long-term target, 10% annual unit growth. For a chain that had opened as few as 3 restaurants in some recent years, that would be an entirely different company. But Darden has run this experiment before, and the results are instructive. When it bought the Capitol Grill in 2007, that fine dining chain had 28 locations. Roughly 16 years later, it has 61. Real growth, a 117% increase, but averaged out to closer to 5% a year, and not 10. Eddie V's, another fine dining brand Darden acquired in 2011, grew from 8 locations to 29 over about the same stretch. Even with Darden's balance sheet and real estate expertise behind them, fine dining brands simply don't compound the way a fast casual chain does, because every new location still needs the trained kitchen brigade, the wine list, and a trade area wealthy enough to support it. So, the question hanging over Ruth's Chris today isn't whether Darden can fund faster growth. Clearly it can. It's whether the thing that built the brand in the first place, the sense that this is not a restaurant you find on every corner, survives being doubled at twice the historical pace. Darden is now the one deciding how much of that scarcity the Ruth's Chris name can spend, down before diners stop believing the $60 plate is worth it. If Ruth's Chris built its business around scarcity, Texas Roadhouse built its entire identity around the opposite: get big and get big fast. The chain's origin story is almost the inverse of a Wall Street success narrative. In February 1993, a 37-year-old Kentucky native named Kent Taylor opened the first Texas Roadhouse in a converted car dealership, not in Texas but in Clarksville, Indiana, just across the river from his hometown of Louisville. He had reportedly been turned down by more than 80 investors before a small group of local backers and a Small Business Administration loan got the first location open. The Texas branding was itself a calculated bet. Borrowed cowboy imagery and a menu built around hand-cut steaks and made from scratch sides, priced well below what a white tablecloth steakhouse would charge. Where Ruth's Chris protects its brand by staying small, Texas Roadhouse's strategy depends on the opposite instinct: expand as fast as the unit economics allow. The company went public on NASDAQ in 2004, raising roughly $70 million, and built an unusual structural mechanism into its growth plan: the Managing Partner Program, giving the general manager of each individual restaurant a direct equity stake in that location's performance, rather than just a salary. For a company planning to open hundreds of restaurants it can't personally supervise from headquarters, that turns every general manager into a part owner, with a financial reason to run their location as if it were their own. The scale that strategy has produced is striking next to Ruth's Chris. By the end of 2024, Texas Roadhouse operated 666 company-owned restaurants and 118 franchised locations across 49 states. More than 4 times Ruth's Chris's entire global footprint, built from a single Indiana location in just over 30 years. That scale isn't limited to the flagship brand either. Texas Roadhouse has spent the last decade building out a second concept, the sports bar-styled Bubba's 33, specifically to capture growth in markets that don't need another full steakhouse. Spreading the same volume playbook across a second, related format rather than betting everything on one brand's ceiling. Between both brands, the company now operates in roughly 10 countries outside the United States, through franchise partners, using the same low-capex, high-turnover model abroad that built its domestic base, a far more aggressive international footprint this early in the company's history than Ruth's Chris ever attempted with its franchised locations. Full year 2024 revenue reached $5.37 billion, up just over 16% from the year before, following a 2023 the company itself called outstanding, driven by double-digit same-store sales growth and a record number of new system-wide openings. First quarter 2024 alone brought revenue of $1.32 billion, up 12.5% year over year, with net income climbing 31% to $113.2 million. The economics behind that growth are the mirror image of the fine dining playbook. Rather than relying on premium pricing to expand margins, Texas Roadhouse keeps its average capital investment for a new restaurant around $8 million. Modest next to the real estate and build-out cost fine dining chains carry in top-tier trade areas and drives profitability through volume, high guest counts, disciplined labor costs, and a no-reservations high-turnover dining room built to seat as many people as possible on a Friday night. The result is a net margin of roughly 7.5%, actually higher than the 7.6% Ruth's Chris reported at its own peak, despite charging a fraction of the price per plate. Over the last 5 years, the company has grown earnings at an average annual rate of 26.6% and revenue at roughly 16.3% a year. A pace no fine dining steakhouse chain in this category comes close to matching. That volume, though, is exactly what makes Texas Roadhouse's next chapter harder than its last one. 666 company restaurants is already a number most casual dining chains never approach. Every additional location competes for a shrinking supply of available sites, construction crews, and general managers willing to take on the managing partner equity risk that built the brand in the first place. Ruth's Chris can raise its price 9% and let a handful of stores carry the growth story. Texas Roadhouse doesn't have that lever. Its entire model depends on staying accessible, which means the only way to keep growing at a rate that has averaged over a quarter of its earnings every year for 5 years straight is to keep building market after market until there's nowhere obvious left to put the next Roadhouse. If Ruth's Chris chose scarcity and Texas Roadhouse chose volume, Outback Steakhouse tried for a while to choose everywhere, and the last 2 years have been spent unwinding that bet. Outback opened its first restaurant in Tampa, Florida in 1988, founded by 4 partners, Chris Sullivan, Robert Basham, Tim Gannon, and Trudy Cooper, around an invented Australian theme that had little to do with actual Australian cuisine and everything to do with a memorable brand. The company went public in 2012 as Bloomin' Brands, raising up to $300 million on the promise that a multi-brand, casual dining portfolio, Outback alongside Carrabba's Italian Grill, Bonefish Grill, and Fleming's Prime Steakhouse, could keep growing steadily across market cycles. For a while it did, and by the 2000s, the company had pushed the flagship Outback concept overseas aggressively, nowhere more successfully, for a while, than South Korea, which it entered in 1997. For years, Korea looked like proof that Outback could scale a mid-priced, casual American steakhouse concept internationally in a way none of its domestic competitors had managed. By 2014, the market had grown to 110 restaurants, Outback's second largest by store count after the United States, and industry observers had called the expansion a success story as far back as 2008. But the same year that milestone was being celebrated in hindsight, the wheels were already coming off. South Korea's economy slowed, Outback had expanded faster than the market could support, and same-store sales that had been growing 6% a quarter collapsed to flat, then negative, down 5.6% by the first quarter of 2015. Bloomin' closed 36 Korean restaurants in late 2014 and early 2015, cutting the footprint by roughly a third. Then, in 2016, rather than rebuild it as a company-owned business, Bloomin' sold the entire Korean subsidiary outright for $50 million, converting every remaining restaurant to a locally owned franchise. The growth market chapter of Outback's international story had effectively ended nearly a decade before the closures this video covers. That pattern, aggressive expansion, followed by pruning, followed by a decision to own less rather than more, has repeated inside the United States more recently at a larger scale. In February 2024, Bloomin' Brands announced it was closing 41 underperforming U.S. restaurants, the majority of them Outback locations with leases dating back to the 1990s and early 2000s, old assets in trade areas that no longer supported the brand's traffic. The company framed it as portfolio discipline rather than retreat, pairing the closures with plans to open 40 to 45 new restaurants across its brands that same year, but the underlying numbers kept deteriorating. In the first quarter of 2024, Bloomin' posted a net loss of $83.9 million, compared with $91.3 million in net income the year before, on revenue that fell from $1.245 billion to $1.195 billion. Outback was never really a single brand bet either, which is part of why its struggles are more survivable than they might look from the headlines about closures. Bloomin' Brands' other 3 concepts, Carrabba's Italian Grill, Bonefish Grill, and Fleming's Prime Steakhouse and Wine Bar, have moved through the same period with genuinely mixed results. Carrabba's has posted same-store sales growth even in quarters when flagship Outback was declining, while Bonefish has been the weakest performer of the 4 in several recent periods. That portfolio spread means the company's turnaround plan can lean harder into whichever brand is working in a given year, something a single-concept company like Ruth's Chris or Texas Roadhouse simply doesn't have the option to do. Not every part of the business has been shrinking. Off-premises orders, takeout and delivery, have more than doubled since 2019 and now make up roughly 23% of Bloomin's U.S. sales, one of the few genuine growth lines the company has, and a sign that even a struggling dining room brand can find volume once it stops asking customers to sit down at all. By September 2024, the company had a new chief executive, Michael Spanos, brought in after a round of corporate layoffs and a decentralization of decision-making away from headquarters and back toward the individual brands. Under the new leadership, Bloomin didn't just keep closing U.S. restaurants. In 2024, it sold a 67% stake in its Brazilian Outback operations to the private equity firm Vinci Partners for roughly $225 million, trading ownership of a genuinely successful international market for cash and a lighter, refranchised footprint. New restaurant construction slowed sharply too. Only 18 to 20 company-owned openings planned for 2025, versus dozens in prior years, freeing up roughly $40 million that would otherwise have funded new buildings and redirecting it toward remodeling the restaurants Bloomin already had. By the third quarter of 2025, there were genuine signs the strategy was working. All four of Bloomin's brands, Outback, Carrabba's Italian Grill, Bonefish Grill, and Fleming's Prime Steakhouse, posted positive comparable sales growth for the first time since the first quarter of 2023. But the company kept closing restaurants even as sales recovered. 21 more U.S. locations shut down that quarter, with 22 additional leases confirmed not to be renewed over the following 4 years, and roughly 40 more Outback closures planned to run through 2026. Revenue that quarter was essentially flat at $928.8 million, and Bloomin still reported a net loss of $45.9 million. What all of that adds up to is a company that spent 3 decades proving a steakhouse concept could travel almost anywhere. American strip malls, Brazilian cities, and for a while, the single most successful casual dining format in South Korea, and has spent the last 2 years systematically shrinking every part of that footprint it no longer believes it can profitably defend. Outback isn't betting on scarcity like Ruth's Chris, or volume like Texas Roadhouse. It's betting that a smaller, more consistent version of the brand it already built is worth more than the sprawling one it spent 30 years assembling. Ruth's Chris protects scarcity. Texas Roadhouse chases volume. Outback is retreating from a footprint it can no longer defend. Fogo de Chão is the one company in this comparison, still finding room to grow in the gap between all three. The brand didn't start as an American company at all. Brothers Ari and Jair Kozer, together with 2 more family partners, opened the first Fogo de Chão in 1979 in Porto Alegre, in the far south of Brazil, built around churrasco, meats grilled on skewers over an open flame and carved tableside, continuously, until a guest turns a small card on the table from green to red. It stayed a Brazilian restaurant for 18 years. The first location outside Brazil didn't open until 1997 in Addison, just outside Dallas, a deliberate choice according to the founders, because Texas already had a barbecue culture that made the concept feel familiar rather than foreign. For the next 16 years, Fogo de Chão grew the way a lot of founder-led restaurant companies grow, carefully, between that 1997 Dallas area opening and the end of 2013. The company added a total of 29 new restaurants across Brazil and the United States combined, well under 2 a year on average. That changed once private capital got involved. Thomas H. Lee Partners bought a stake in 2012 and took the company public in 2015. When the public markets didn't reward the stock the way ownership wanted, Roan Capital took it private again in 2018 for $560 million. Under Roan, growth accelerated sharply. By 2021, average annual sales per restaurant had reached $7.9 million. A year later, that had climbed to $10.1 million, with total revenue up 43% year over year to $517 million. That performance was strong enough that in August 2023, Roan sold Fogo de Chão to Bain Capital, in a deal reportedly worth around $1.1 billion, nearly double what Rhone had paid just 5 years earlier. With the company by then in its third consecutive year of at least 15% annual revenue growth, Bain Capital was not a random buyer. The firm has a track record of restaurant investments that includes Burger King, Dunkin', and Domino's Pizza. And the Fogo deal fit a broader pattern of private equity, treating full-service dining less like a mature, low-growth category and more like an operating platform that simply hadn't been run with enough capital discipline yet. That growth rate held under the new ownership too. Fogo opened its 100th restaurant in 2024, added 16 more locations globally in 2025, and entered 2026 with plans for 14 to 16 additional openings, including its first restaurants in Chile, Costa Rica, and Honduras, alongside new U.S. locations from the Las Vegas Strip to suburban New Jersey. Earlier expansion announcements had already flagged Turkey and Bolivia as future markets. A churrasco concept from southern Brazil, now planning restaurants on 4 continents, something neither Ruth's Chris nor Texas Roadhouse has pursued at anything like the same pace, and something Outback tried once in Korea before selling that very market off. What makes Fogo's position genuinely distinct isn't just the growth rate, it's where its unit economics land relative to the other 3 chains in this video. A dinner at Fogo runs somewhere in the range of $60 to $75 a person for unlimited, tableside carved meat, priced closer to Ruth's Chris than to Texas Roadhouse, but at $10.1 million in average annual sales per restaurant. A typical Fogo location still does more business than a typical Texas Roadhouse, despite a fixed price, all-you-can-eat format that on paper looks harder to make money on than an a la carte fine dining menu. Part of the answer is table economics. A rotating cast of servers. Carving meat tableside is labor-intensive, but the fixed-price, continuous service model turns tables efficiently and eliminates the complexity and the kitchen labor of an a la carte menu with dozens of individually prepared dishes. Fogo captured something genuinely rare in full-service dining, an experience expensive enough to feel like an occasion, but standardized enough to scale like a system. If you've made it this far into a business documentary that treats restaurant unit economics as seriously as anyone treats a corporate collapse, we genuinely appreciate you subscribing to the channel. We publish a new autopsy like this one every week, and there's a lot more where this came from. With that said, back to the stakes. Because even Fogo de Chão, the fastest growing and highest revenue per restaurant chain of the 4 companies in this video, still needs a human being standing at every table with a skewer. Its labor model is more efficient than Ruth's Chris's, but it isn't gone. The same store sales growth, the private equity returns, the international expansion into 3 new countries in a single year, all of it still runs through a dining room full of servers doing something a screen cannot do. Which raises the question this video has been building toward from the start. Is there any version of the restaurant business that escapes that constraint entirely? And if there is, what does a business that has actually escaped it look like? Next to these 4, here is the number that makes sense of everything in this video. McDonald's, the largest restaurant company in the world, closed its 2024 fiscal year with an operating margin of roughly 45.7%, and pushed that even higher to about 46% in fiscal 2025. That is not a fluke of one good year. McDonald's operating margin has sat somewhere between 39 and 46% every year since 2020, through a pandemic, through the worst restaurant industry inflation in decades, and through a cost of living squeeze that has hammered nearly every other chain in this video. The reason is structural, not seasonal. Roughly 95% of McDonald's restaurants are owned and run by franchisees, not by the corporation itself. McDonald's mostly collects rent and a royalty, typically 4 to 5% of each restaurant's sales, plus rent on real estate. The corporation itself often owns a share of revenue that arrives regardless of what a given store's labor costs or beef prices did that quarter. Scale adds another layer on top. As one of the largest beef and potato buyers on earth, McDonald's reports a gross margin of roughly 57%. well above the 45 to 50% typical of its own industry. Purely from purchasing leverage, no single steakhouse chain in this video can match. The company that sells hamburgers has engineered itself into something closer to a landlord that also owns the recipe, and for comparison, the broader franchised quick service industry it competes in typically runs operating margins in the 30 to 35% range, itself already more than 4 times what any steakhouse chain in this video reports. Chipotle and Yum brands, the parent of KFC, Taco Bell, and Pizza Hut, land in a different spot on the same spectrum, but the direction is identical. Chipotle owns essentially all of its restaurants rather than franchising them, so it doesn't get McDonald's royalty and rent cushion, but its assembly line service model, standardized menu, and premium pricing still produce restaurant-level margins in the 25 to 28% range, several multiples above anything in this video's 4 steakhouse chains. Yum Brands runs the opposite structure to Chipotle. More than 31,000 of its restaurants are franchised versus fewer than 500 company-owned, and reported a company restaurant margin of 24.4% in 2024, with total operating profit up double digits on revenue growth of just 8%. Different mechanisms, the same outcome. Strip labor-intensive table service out of the model, whether by franchising it away or replacing it with a counter and an assembly line, and margins that would be extraordinary for any restaurant become routine. Now put the 4 steakhouse chains from this video next to those numbers. Ruth's Chris, at its most profitable public year, reported a net margin around 7.6%. Texas Roadhouse, the best run and fastest growing of the 4 by scale, reported roughly 7.5%. Fogo de Chão, growing at 15% a year under 2 rounds of private equity ownership, has built its edge on revenue per restaurant, not on keeping a McDonald's-sized share of that revenue. And Bloomin' Brands, the parent of Outback, posted a net loss in 3 of the last 4 reporting periods referenced in this video, or none of the 4. Not the disciplined luxury operator, not the volume champion, not the fastest grower, not even the one currently in retreat, gets within 20 points of what McDonald's keeps, or within 15 points of Chipotle or Yum. That gap is not a management failure at any of the 4 companies. It's the ceiling the entire category operates under. No matter which strategy you pick, a steakhouse, by definition, sells a piece of meat cooked to a specific temperature, delivered by a person who can answer questions about it, in a room that has to be staffed for the 2 or 3 hours a table is occupied. You cannot franchise your way out of that labor cost the way McDonald's did, because the whole product depends on a service quality a corporate parent can collect royalties on, but never fully remove. You cannot assembly line it the way Chipotle did, because a $60 ribeye or a tableside carved picanha is not a burrito built in under a minute. Every dollar these 4 companies have found, through scarcity, through volume, through international expansion, through private equity discipline, has been squeezed out of a business that structurally cannot get the one thing that actually explains McDonald's 46% margin, a model where the person serving the food isn't on the payroll at all. That is the autopsy. 4 different answers to the same question, and not one of them has found a way around the only line item that has never had a discount version. Go back to that dining room from the beginning of this video. The linen tablecloth, the nearly 500-degree plate, the $60 ribeye. Nothing about that scene has actually changed by the end of this story. The plate still arrives too hot to touch. The server still knows the menu by heart. That ritual is exactly as expensive to produce today as it was when Ruth Fertel first bought a steakhouse on Broad Street in 1965. Arguably more expensive once you count what beef, real estate, and labor cost today compared with the 1960s. What's changed is everything around that ritual. Ruth's Chris spent 60 years proving that if you keep a steakhouse rare enough, people will pay a premium for the privilege of scarcity, and then sold itself to a company now betting it can double that growth rate without breaking the thing that made it valuable. Texas Roadhouse proved the opposite is just as viable. Cut the price, give every general manager a direct stake in their own restaurant, and outbuild almost every other casual dining chain in America, one main street at a time. Outback proved a steakhouse concept really can travel to almost anywhere in the world. Australia-themed, invented in Tampa, once the second biggest restaurant chain in South Korea, and then spent the better part of a decade discovering that having a footprint everywhere is not the same as being able to defend it everywhere. And Fogo de Chão proved there was still room in the market for a fourth answer nobody had tried at this scale. Import a foreign format, run it patiently for 16 years, then let 2 rounds of private equity compress a decade of growth into 5. 4 different bets, 4 different outcomes so far, a growth brand, a discount champion, a company in retreat, and a private equity growth story still accelerating. But every one of them tops out well below what a McDonald's, a Chipotle, or a KFC can produce from the same dollar of revenue, because none of them has found a way to take the person out of the room. That's not a flaw specific to Ruth's, Chris, Texas Roadhouse, Outback, or Fogo de Chão. It's the actual price of the ritual. The steak arrives sizzling because a person carried it out of a kitchen and set it down in front of you at the right moment. And no franchise agreement, no private equity fund, and no unit economics model has yet figured out how to bill you for that without paying someone, in full, to be there. The steakhouse, in other words, is the exception that proves the rule of the entire restaurant industry, not because it escaped the constraint that keeps most restaurants running on razor-thin margins, but because it's one of the only categories where customers still pay enough to make that constraint survivable. Whether that holds for another 60 years, across 4 companies making 4 different bets on the same $40 of dependence on another human being, is the question this whole industry is still answering, one steakhouse at a time. It's worth sitting with what that actually means for anyone eating at one of these 4 chains this week. The premium at Ruth's Chris isn't really paying for the beef. Cattle futures move the same way for every restaurant in this video. It's paying for the fact that a trained person is standing at the table, and that person's judgment, timing, and hospitality cannot yet be franchised away the way a Fryer schedule can. Texas Roadhouse charges less for the same underlying labor because it captures that cost through volume instead of price. Fogo de Chão captures it through turnover and a fixed menu, and Outback is currently finding out, restaurant by restaurant, exactly how much of its footprint that labor cost can no longer support at a price customers are willing to pay. 4 companies, 1 bill, and no way yet found to make someone else pick it up. If you found this useful, subscribe. We publish a new business autopsy like this every week, and the next one is already in the works.